Good morning, good afternoon, and good evening, investors. Hope you guys are doing well. We have got a very special episode with a local Austinite here who has done a really great job in a I won't say long period of time, but semi-short period of time as a becoming a real estate investor and leaving his family's business here in local Austin, Texas. Now, the guy graduated from Westwood. He went to UT. You can't be bleeding more burnt orange than what he is doing. And he's here today to share his kind of his investing journey, how he got into it, but also what he's doing now. He's upped his game into mobile home parks, syndications, and doing some amazing stuff. So who am I talking about? I'm talking about the chief bottle washer over at Runsteady Investments. Our buddy Ian Noble joined us today. Ian, how's it going today, man?
It's a great day, Scott. Thanks for having me.
Yeah, glad to have you, bud. I mean, we were talking beforehand, and I love your Marvel origin story. You know what I mean? We all start doing some different things, stuff like that. But we've got so many people that listen to the show that are probably facing the same things that you're facing. They're working in a job or a career, and they maybe want to do something different with it, or they want to move, something that's going to make them more money, maybe find a little bit more freedom with what they're doing. So why don't you take a second and kind of talk what you were doing before you got into investing and what attracts you to becoming a real estate investor? And then we can talk more about how that evolved and the different niches that you're in now.
Yeah, great. So you mentioned I grew up here in Austin and went to UT. I graduated college in 2009. So at this point, it's the recession was going on. It was difficult to get a job. A lot of my buddies were going back to school to be doctors, lawyers, whatever. And my dad had this business, and so it's called Rick's Cleaners. It's here in Austin, and he started it in the '80s. And he was pretty burnt out, and he had removed himself from the business. Just it's you've put so many years into something, and you've lost your fire. And he approached me because it was never a plan. This wasn't a fallback for me to go into the family business. He approached me when I was looking for a job or about to get out of college, said, "I want you to come and try this. You're going to learn more than you do at any MBA program or working for any consulting firm. I promise you." And I'm very happy I took his advice. I went in there. This is 2000, early 2010. I left school and went to travel for a little bit, and when I got back, it was time to go. So
What was your favorite place to travel while you were out doing your vagabonding?
yeah, so you might be able to see there's a picture in the back there. That was in Thailand. I did a lot of Southeast Asia. Um, Love it. Friendly people, really
Yep.
inexpensive.
Very
Yeah, yeah.
expensive.
So I
That's
had we
awesome.
yeah, we had a group of us that went after college, and so got into the dry clean business. I did not own the business. I wasn't, my dad still owned it, but we never really worked together. There were these two gals running it, and he had removed himself from the business just because he didn't want to be there. Uh, this is full circle because I think the reason he was able to do that was because he had real estate. So I grew up knowing dad was a real estate guy, an entrepreneur, and I naturally just kind of fell into that same path. So I think I've only received a paycheck from one company before in my life, like when I was in high school, that wasn't my. So I'm just used to being an entrepreneur and
Yeah.
working for myself, and I've had a lot of fun. So yeah, I bought it from him a couple years later, went seven figures into debt, started rocking and rolling, building that business up, and then got into real estate along the
So,
way.
so when you bought it from him, did he finance it to you? Did you get bank financing for it, or how did you kind of finance that
Yeah, it
purchase?
was seller finance. It was it was a sweet
You're in the
deal.
note business, baby. So
Yeah.
technically, you're in the note business with a seller finance note there. That's awesome.
Yeah, yeah, in the note business, and so it was like I mentioned, it was a friendly transaction. It was a little bit different than if you'd have a third party buying your company. Obviously, the due diligence was less. I had already been running it for 5 years at that point, and I consider myself the owner, even though I wasn't. So this was 2016. Uh, Woke up on whatever day that was, a Tuesday or Wednesday, and some paperwork had changed. But for
Yeah.
me, it was like, all right, it's time to. I didn't change my, the way I was doing things, but I was already again running it like it was my own.
So
And
let me ask you a question. Working in it before you bought it and coming out of college, what did you study at UT?
I was an economics major.
Okay. Okay. So you took some
Nothing.
business classes, some finance classes as well, stuff like that for you. But coming in as the son, Did you have some ideas to improve the business? Did you have some ideas? Hey, Dad, we should do update some things or do some things differently than we've been doing. And if you did, was he receptive to that, or he's like, "Oh no, this is how we've done business for years. This is how we're going to keep doing it."
Yeah, luckily he was kind of agnostic. He's too smart to say don't change it. He knew that it needed to be changed just because he wasn't going in to work. And so for that, yeah, there was a really good foundation, a lot of low-hanging fruit that I could implement changes right away. One of those being a point of sale system, company uniforms, um, some online presence. Get this, Rick's is what they used to call and still do a discount cleaners. It's a flat one price. And when I first got into the business, had a coupon on the website that was, I think, 30 cents, 40 cents cheaper. And the coupon was up 100% of the time. So even though we set a price, it's like everybody was paying a lesser price. And so it's just really simple changes. I mentioned the uniforms. We'd have people wearing whatever kind of shirt they wanted to, showing as much skin as they possibly could. And I was like, all right, let's clean this business up a little bit. So, there was
Come into you literally would want to give him the shirt off your back.
yeah, I was like, cover up, please. Take this take this company polo. So, yeah, that business is interesting. There's a lot of customers, high foot traffic. It's a volume-based business, and it's just repetition and doing the little things that are hard over and over again. And even when you think that quality was the first one, when I first got involved, I didn't really have a role. I knew that I wanted to be the owner, but where do you start? And we had poor quality. It's always a challenge. If you slack off, with training or whatever, quality drops. So I started pressing clothes. I went into the plants. We call them the plants. That's where all the pressing equipment is. And I'm telling you, it's back-breaking work. I thought I was 21 years old. And I was like, this is going to be so easy in terms of fatigue, right? But like, I remember leaving my first day, I pressed from 4 in the morning until like 2 p.m. and over and over. And what was good about this was two things. Number one, I found an appreciation for what the team does. I was in pain. My back hurt, leaving. My whole body had a heat rash leaving that day. I was like, it was hot. The cleaning facilities, they get warm, especially in the summer. Like you can't cool them like you can your house. There's steam and heat everywhere. Um, but not only that, then the team started returning all of my clothes. I wasn't pressing well, and there was a lesson to be taught here. It was, hey, quality matters, because before it was this whole team dynamic of they didn't want to return the clothes to you. You might get upset, right? That somebody returned the clothes. So it was really good. It was a teaching process for me, for the team, and yeah, started doing every position. I was very much an owner operator, tad clothes, worked on stains. I know way too much about fabric and the chemistry of removing stains, but yeah,
But
love
that
it.
also builds respect by the existing employees too. You know what I mean? I'm sure they could take, oh, here comes the owner's son, whatever. Don't take him serious. What's he know? But the whole like starting the mailroom, working up, starting at the bottom and working up, builds respect with the team, and you understand, like you said, the day in day out activities. Not that your dad didn't know that. Obviously, he knew that building the company, but it
Yeah.
adds a new respect for your staff and employees. I'm sure you saw some good stuff when he would implement changes that they were much more willing to hear from it because you'd been in their shoes.
Yeah, not only that, it's that whole I had to change the culture. It was that whole it's not my job mentality. I think that's one of the most irritating phrases. It's not my job. So that
I
that
don't
was
get
it.
paid to do that. Well, yes, you
Yeah.
do.
Yeah. So I would this was a fun exercise. It would weed out the staff if they weren't going to be good team players. I would, like, let's say I asked them to clean the bathroom. It's not my job. So I would get on the floor and I would clean the bathroom and scrub the toilet in front of them to show them that, hey, nobody is exempt from this, right? Like, just because you think that at this point I'm the owner or the owner's kid or whatever it may be, like, this is a team sport. Everyone's got to play for
Yep.
this thing to be successful. So I learned so much from running that company that the confidence there, that fast forward 13 years, like, I think, when I go buy another company, remove that final product of whatever our service was, which was cleaning clothes. You can do everything else that's behind the scenes: payroll, HR, advertising, the same stuff that you have to do for your podcast and all the work. Everything is hard work if you're in it for the long haul.
Yeah, that's so true. So true. So you're running this and saw your dad had also been a real estate investor. When did you start getting that real estate bug, that real estate itch aspect of things?
2014. I bought my house in 2012. That was just my primary
Sure.
residence. Austin was different back then. This was over
Yeah.
by the Mueller area, 159,000 for that house.
Add
And
about what, 600,000 or $500,000 to it now, probably for the most part. If not, well, no, that would just be the appreciation. Let's not
COVID
add.
was, yeah, COVID was friendly. Then everything settled. You
Yeah.
know the market. But yeah, I started there, bought my first rental in 2014. And the idea was, you know what, if I can buy enough property, over and over again, someday in 10, 15 years, it's gonna pay off. And I just stuck to it because there's not, you're in the real estate business. There isn't a ton of cash flow from running single family rentals, but the opportunity that it brings up for you later in life, or just to get you in the game, I still encourage it. It's funny, everyone has their specialty now. When I talk to the real estate world, and some people think multifamily is the best or commercial properties, and it's like, no, you can make it in anything. You just
Yeah.
have to pick your lane because there's a ton of ways to do it. But residential rentals are a good way for people to get involved. So yeah, 2014, bought a rental, did it again in 2015, again in 2016, and then it started looking at little commercial properties. Experimented with triple net leasing, and really enjoy that too. So yeah, I just like kind of kept buying properties, and then when I sold the cleaners and got to the end, it was like it was what I knew. So it was the blend of real estate and entrepreneurship, and I just knew that was the path I was going to continue on.
Yeah, that definitely makes a lot of sense. I mean, I always say it's good to get your feet in the game. You're gonna learn more by doing your first deal
Yeah.
and than you will from any other class. Don't get me wrong, it's good to have classes that have mentors and stuff like that. And who was your mentor? Your father, or did you have somebody else that you brought on as a mentor to help you hold your hand along the way?
I wish I would have engaged or been intentional about getting a mentor. So there, my dad, yeah, inadvertently along the way, he was there, but he is just, if you ever met him, guy's never met a stranger, just likes having fun, laughs a lot. But if you're to talk serious about like, hey, how can I strategize to do X, Y, Z? Maybe dad's not the guy because he just wants to, shoot the crap with you. So, but yeah, he naturally was. There were some other people along the way, but no, I wish I would have had a more formal mentorship structure. I was listening to podcasts, believe it or not. This is 2014, Bigger Pockets podcast,
Yep.
way back in the day. And I think that was part of the motivation of like, let's go get a property. Oh, if I only make 200 bucks a month or 300 bucks a month, it's fine. And I still tell people that today. Like, if you want to go and get started, go do it. Make money in your primary profession or career,
Yep.
and because real estate will not change your life that fast.
Yep.
It's a long game, and don't quit your day job yet. So that was the plan, and it was fun. But yeah, certainly isn't an income source in the very beginning. It does become one later. These tenants eventually pay off their properties, and then it's like, all right, this is good stuff.
Yeah, that definitely, with the appreciation, refinancing, lower rates, there's a way to boost the cash flow. Obviously, not having to do a full rehab a lot of times, if you get a longer term tenant, definitely helps out with that too for you. But what made you, and then you go into the commercial triple net stuff, but then what was the next evolution? Was it into multifamily or self-storage, or you like the syndication side? What was kind of the next step for you, Ian?
Yeah, so the next step evolved from when I sold the business. This is 2023. Um, I remember it was October of 23. And so I walked out of there and I'm super pumped, and all this hard work had paid off. And then a couple days later, I think I was having an identity crisis. Like I
What the
was,
hell do I do now, right?
yeah, who am I? My daughter used to, so she's like, my dad's a dry cleaner. And Nat, she was like, what are you doing, dad? And trying to explain to my daughter, I'm a young guy. I'm trying to say, well, I didn't like using the term landlord. I don't know. I didn't know how else to describe myself. Like, dad's a landlord, but I don't know. It's confusing for a 5-year-old kid. Well, now she's 5, but at the time she was 3 years old. And so this led me to look at, all right, what can we do? I just sold the cleaners. I just finished paying off the 7 figures debt from buying it from dad, and I needed a place to make more money, continue it, maybe mitigate some taxes. Real estate was the answer for me. It's why I got into bigger projects. So that year I did a cost segregation study on all my properties, which I hadn't done before. And then in addition to that, I ended up putting some money into some syndications. And basically, I know you know what it is, but for anyone listening, a syndication is just people pooling money together to go acquire property. Often it means you're passive.
Yep.
And so in that short period of time, I was like, I don't have the time to go identify a property, put together a team, make it worthwhile. I only have 60 days. So I got involved in a couple syndications, mobile home parks. There was the self-storage and mobile home park blend, but mobile home park was the attractive thing for me. And I really like that asset class because there's an affordable housing crisis.
Yep.
There is still barrier to entry, believe it or not, because like cities don't want you building a new mobile home park. So there's kind of a supply cap to it. And there's just a lot of good communities. And it's funny, like people that I talk to that aren't in real estate, people in real estate get it. But if you're not in real estate, they're like, trailer parks, what are you messing with that junk for? And I'm like, you've got it all wrong. There's a bad stigma with that asset class, but that's because they don't, these people don't know better.
Yep.
Mobile home parks have been around for years. They kind of, I like to say they've flown under the radar. They've just always been a consistent producer, but they're not like they weren't always the hottest thing that people wanted to invest in. So yeah, I focused on that, and what helped me that year was the depreciation. You mentioned like making money in real estate. It's like if you make money from your job or your business, you make it in the source of income, and it's that year. Maybe if you own the business, you can get some, the sale of your business. But you get real estate, you get depreciation up front, you get cash flow while it goes along. You can have refinance, which is tax-free money, and go do it again. You get upside. So there's four ways right there that we listed making money. You'd probably be like, those are a lot more than that, but those are four key ones. Um, and I just I was doing that and ready to go back and buy another business. And my wife was like, hey, don't forget why you got out of the dry cleaners. And I didn't share that story, but there wasn't anything that went wrong. I was young. The business was successful. We survived COVID. COVID was pretty brutal for the dry cleaning industry.
Sure.
But those that made it out started to thrive and acquired a lot of the companies that shut down. When I say acquired them, the customers naturally, like those businesses just closed their doors, but naturally the customers had to go somewhere. And so after all this, I would go home and I was just emotionally my head was somewhere else. Looking at my kids, I have three kids now, by the way. I had two when I sold the cleaners. And so I just know I needed a change. My
Was
heart was
that the celebration was the third kid?
the third, yeah. Why not
Hey,
another?
honey, let's celebrate.
Oh, I'm so grateful. My third is so easy. He's an easy baby. So
But I'm glad you bring that up because a lot of people get bogged into that day in day and that slog, and it may not have been a slog, but I think a lot of us, especially if you're an entrepreneur, you're looking for something new. The especially as entrepreneurs, it's great to start businesses or dive into businesses and get them up and running, but there's also like okay, only so much you can do until you find something. And if you're not accentuating that creativity bug, it ends up you get burnt out pretty
yeah.
fast. Would you say you were burnt out basically?
I was burnt out. Yeah. I wouldn't have had the business was doing well. I couldn't go and replace my income somewhere else.
Right.
And so it was a choice of, of time, freedom. I'll call it free. I don't
Mhm.
like using the word freedom, but it was the freedom choice to say, I can take advantage of the time that I have. I was fortunate to be placed in a situation. I worked very hard for those 13, 14 years, built it up, and then let's have some fun with, spending time with the little kids and then have some fun helping other people as well. And so what I mean by that is once I got involved with these syndications, I realized, hey, I've been an active investor in real estate for 10 years now, and I know what sort of returns I get from it, but it's actually a lot more fun to use other people's talents and leverage their team and and then you still get the majority of the profit and you get all the benefits. So I started doing that. And shortly after, I was like, I want to help other business owners do this because business owners who are successful, we all lack time. That's one thing in
Yeah.
life that whether you're rich or poor, we all have the same amount of time. But obviously, money or resources allows for people to sometimes buy back their time. So my goal was to help others because I always thought, well, I got to buy one real estate property at a time. But then I realized, had someone come to me 10 years ago and said, we can use your money. You can set aside your money right now, put it into a deal where you're passive and you're going to get the same returns, same benefits. I've been like, yeah, sign me up. I will say this from an entrepreneur's mindset, you're used to P&L, you're used to control, and you're running these, everything yourself. And then passive investing, that was an obstacle for me and a mental hurdle to give that away to somebody else and say, hey, here you go. Um, so that's a lot of what I do now is vetting people, building trust, invest my own money with them first. So, yeah, we just pool together money. We go help people buy properties they never would have been involved with. Usually not real estate people. These are business owners around town, most of them in Austin.
Yep.
Um, vet offices, dental clinics, restaurants. These are the owners that don't have time, but they've got the money, and like we all co-invest as a group, and it's a fun process.
Yeah, totally makes sense. A lot of stuff. I want to go back to a couple things because
Yeah.
people, when you were talking about mobile home parks, or it's what some people used to call them shit boxes, and I'm like, they're not shit boxes unless you like the smell of money. You know what I mean? And the mobile home communities, especially, has been really fragmented. It's probably the most fragmented when you look at the commercial asset classes out there compared to like self storage or
That's
multifamily
right.
stuff like that. But the yield on them, and I don't mean it's a negative thing. Poor people pay more for housing, and so
Yeah.
if somebody's not able to afford a house, they're going to be glad to get into a house or a mobile home on a half acre or on a lot, something they can call their own versus renting and stuff like that. So yeah, they may pay a little bit more, stuff like that, but it's still a win-win out there. You being able to provide a quality product or someplace for them, someplace they can call home, and do it with a bit of a community aspect of it. And like you said before, we have such a huge housing need out there. And if you ever want to have a different take on mobile homes or stuff like, just go out to Community First, Alan Graham's community out on the
Yeah.
east
He's
side
done a
of
great job.
Austin. That will change your whole mind about mobile homes or tiny home communities, right, Ian?
Yeah, there are so many again, with the bad stigma, a lot of people just don't know. There are a lot of really nice places
Yep.
all over the country, places that you would you'd want to live in or take your family. Like, and I mean that. I've seen some in Utah, California, Florida. Like they're all over. But not only, you mentioned something about community, and that's one important thing. We recently closed on a deal in Nashville. It was 150 units, a couple of parks that were really close to one another. It's not technically Nashville, it's Clarksville, which is
Yeah, yeah, that's close.
Austinite. This is
Yeah.
Austin to Round Rock. It's very close. It's a suburb. And you go out there and there's kids with trampolines and playing on the basketball court and families, and this is a good community. And you stack that up against, let's say, the average two-bedroom apartment and the cost of what that would be, and just if look at Austin, for example, like if you were to look at a two-bedroom apartment and then on the flip side, someone could go to a mobile home community. Sometimes you pay. There's two different types of way you make rent, or as the owner of the mobile home park. One of them, and the most desirable, is lot rent. That's just the dirt that the manufactured house sits on, and the second one is the home itself. So there's a couple ways to do this, but many of these parks, and what people don't know is that the tenants actually own the home, and you then are just renting the dirt underneath it, providing the infrastructure, meaning utilities, water, sewer, and then they're billed for it directly. So from the landowner, it's a low operating expense. You're providing affordable housing, and there's pride of ownership in that community. There's an interesting stat about the mobile home park space is that the average resident lives in a park for 14 years. So if you stack that up against single family rentals, multifamily, or whatever, nothing compares to it. And the reason for that is because it's expensive to move them. So even if they own that mobile home, they have to move it if they want to move it, and it's usually not cost effective to do so. You can $10,000, $12,000 to
Yep.
to put this thing back on a trailer. But nowadays, some of the new ones that are coming out are very nice. If if you were to take a picture of a kitchen, you might not know what you're inside, but just looking online. So
Well, that's the thing. I worked for Palm Harbor Homes for a brief period in 2008, 2009, and learned so much how, you know, mobile homes are being built differently now on the modular side than they were used to be. And so the construction of them is sometimes it's more effective. I think we could learn a lot building communities doing the modular aspect of things versus how they're stick built in a lot of cases. But yeah, you're right. 14 years average tenancy on they're got a chattel loan, but they're renting that land from you and paying for the utilities through you or through individual meter and stuff like that. That's a phenomenal. That's a locked in client there for quite a bit of time,
Yeah,
right, Ian?
yeah. And it's, there's we look for stuff that has upside. So I'm not talking rundown parks that
Yep.
have a ton of vacancy, but let's pretend it's at 75 occupancy, 75% occupancy, and there's room for growth. And so the way that they're valuing these parks, let's pretend that it's valued at a 7 cap. Well, when you put a mobile home park and get a tenant in there paying lot rent and all like $500-$600 range, based on the rent that you're going to get from that minus the expenses and then divided by the cap rate, you're adding like anywhere between 60 and $80,000 of value for each tenant that you're putting in there. So we look for these opportunities because using that math, I'll take the low figure of $60,000. If you fill up 10 spots that, maybe you have the ability to do so, but there's not residents living there now, 60,000 times 10, you get $600,000 right away with of equity that's basically forced into your operation. So
Hmm.
there's a lot of opportunity there, and I've really liked it for those reasons.
Well, I imagine so when you're buying a couple next door to each other, kind of like you were in Clarksville, that also reduces your overhead costs, maintenance costs, and that adds value to your bottom line as well, too, I imagine, if they're close enough.
Yeah, one manager floats between three parks, 10 minutes away from each other. So, yeah, operational expenses are generally lower because if these tenants own their homes, unlike, if you own an apartment complex, you're fixing their fridge, their range, so or whatever, but you're not doing that here if the tenant owns the home.
Sure.
So it's
Now, are you looking at any opportunities currently in Texas or what parts of the country? Now, the beautiful thing is you're working with Texas investors to invest in other projects across the country. But are you seeing
that's right.
anything in Texas or areas of Texas that you like for this?
I like areas of Texas in general. I honestly, for this asset class, we look outside of Austin,
Oh, yeah.
and so
Yeah, let's-
Austin, I wouldn't advise, because I'm a cash flow investor. Austin has helped people tremendously through appreciation, but if you're buying a deal today, you're not going to be writing home about your cash flow. So around Texas, yeah, there's a lot of opportunity, but really any pro growth market that I mentioned, that last one's in Tennessee. The Midwest is real good for those
Yep.
communities. The Southeast is very popular for the U.S. right now, because in addition to mobile home parks, the other route I go is private lending funds, and those
Yep.
private lending, our whole portfolio and the team that's working on that is in South Carolina. So they operate South Carolina, North Carolina, and Georgia, and that's where this big portfolio is. So yeah, Southeast has been popular now for a couple years, and
Mhm.
just strong, good laws for landlords, and then just strong markets.
Strong
Supposed to
markets. I mean,
be, yeah,
affordability is the most important thing in a lot of cases, and then opportunity out there for, I'm not a big believer of buying something downtown middle of Austin or a bigger market.
yeah,
I think you're going to be overpriced. It's that tertiary outside markets, on the rim that people, and we see that happening here in Texas. That's why Hutto and Taylor have blown up so much because people don't want to spend $500,000 for a 900 square foot condo. They'd rather drive half an hour in traffic to buy a 3 bedroom, 2 bath house for a
yeah.
lot cheaper price. They're willing to offset that. And it's the same thing in just about every major market out there.
Yeah, it's yeah, there's a lot of opportunity, but the majority of my job now is finding the best operators and the best people that I can, because you can have a good deal on paper, and if there's a bad operator, you'll never get to see the deal, the pro forma, I see this a lot in the industry because, again, we're raising money to co-invest as a group. I'm always the first investor, by the way, which is kind of a unique thing that people outside the real estate space don't know. It's not like an advisor in the financial world that's saying, here's your options. Let me take my 1% and Doesn't
They have
matter if
no
it's like,
money invested in the deal. You've got some skin and
yeah,
scratch in the
yeah.
game. Yeah.
So, I mean, if I'm bringing something to the group, it's already been pre-vetted. I'm background checking these people. I've flown out to the properties. I'm putting 50, 100 or more into every one of those deals. So it's like we're all aligned here, and it's not a scenario where this is just trying to place people in something that I don't truly believe in.
You mean
Um,
you're not putting a blindfold on and just randomly throwing a dart at a dartboard? You know what I mean? Oh, hit number 20 was the 20th opportunity there.
You
You
could. It's
know,
out there. But this is coming from the world of being an entrepreneur. You
yeah.
have this control, and and as an active investor, like I still am managing my properties here. So you really got to be careful of who you're working with, and again, a lot of the time is this gut check of like, do I like this person? Do I feel that they will, when times get tough, there have they had failures? All these are the things you want to hear, right? Because if I get somebody that calls me up, Ian, I've got this deal that it's the best thing you've seen. Like, come on, man, I'm a low risk guy. I don't need to be swindled with big numbers. Like,
Yeah.
I want to work with good people. That's
Right.
it.
Well, but that's the thing is, let's just face it, a lot of the multifamily syndicators were high on they're gonna buy something, rehab it, raise the rents, refinance in 3 years, and they have this huge cash flow. And we know that didn't happen. I mean, we know people got really kicked in the huevos with the interest rates increasing and time dragging stuff out, right? That's why San Antonio and Austin multifamily markets not only are overbuilt, but also have honestly a lot of the most amount of foreclosures that we see across the country in some of these multifamily syndications.
Yeah, especially Austin. I know. Well, yes, and San Antonio. And
Yeah.
now those, they got into the flexible rate financing that they ran into these interest rate spikes, and they're selling off at a steep discount.
Or
So
getting foreclosed on and not
yeah,
paying their. I mean, we see
even
a lot of
worse.
that
Yeah,
distressed stuff come across our books, and if we're looking into it, we'll see millions in dollars of mechanics lien filed against the properties, management filing it, because they're not getting paid as well. And so it's unfortunately been a bad thing. But that's what I like so much about what you're doing in the mobile home side of things. That's not you're not seeing huge peaks and valleys on that. It's pretty stable. It's hard to improve the land. I mean, you can, but you're not going to have a lot of downfall in that lot going down at all that you're renting to that
yeah.
bar who's going to be on there for 5, 10, 15 years.
And that asset class, you can still get very high depreciation from it.
Yes. Yeah.
Even though there's not, because when you're doing those studies, you can't count the value of the land, but the land is often not worth that much. So
Yeah.
you're looking at, breaking down infrastructure, utilities, et cetera. And so people surprisingly think that if they know a little bit about cost segregation and depreciation, they're thinking, well, how do mobile home parks work? But you can actually get quite a bit back. So it's not like you lose that benefit of real estate by finding the stable asset. It's kind of the best of both worlds.
Right. Where do you see the biggest bang for the buck as far as like unit or pad sites? 50 plus, 100 plus, 20 plus when it comes to
Yeah,
mobile homes?
great question. If somebody's starting off and they're doing it themselves, I think a lot of people naturally fall in like that 15 to 25 range. There are definitely good opportunities out there because usually these syndications and people with big buying power aren't going in to snatch those up. But from a value standpoint and making it, worth your while, I think 40 units to up to 100 are great. When you get above that, you're now competing with institutional money or very sophisticated operators that are scooping these up. And so there's a sweet spot for sure in that. And again, the whole point of this and how and why like the commercial real estate side versus sometimes residential is like I own rental properties. I'm selling a property right now that just went under contract. It's my very first rental, and it did great over the years for me, but it's only as good as the market and the comp next door.
Yeah.
So in this particular neighborhood, values dropped, and as people are desperate and start to sell right now because they're sitting on these properties, it's like, okay, well, if I thought my house was worth 300 and then the neighbors both sold for 250, my home is worth 250 now, all because of that. But in the commercial world, you're talking about value and bang for your buck. If you get into a mobile home park that has 50 sites on it, and you increase rent by $50. Well, next thing you know, it's like that's substantial versus if I go and increase my rent by $50 to my single family home, it doesn't move the needle. I'm covering some sort of expense, my property tax bill or something that went up. So that's what I like about it. You can really stack, and once you start to see that and then value your business based on like a profit and loss statement and a cap rate, it's like, wow, this is great. And not to
Yeah,
mention
totally is.
the longevity of those tenants.
Yeah, for those listening and watching this, what kind of a minimum amount do they need to look to get invested with you? 50 grand, 100 grand? What kind
Yeah,
of a
usually
dollar
for
amount?
those it's 50 grand.
Yeah.
The private lending fund stuff that's different is 25, but 50 grand. And usually in the industry you're going to see that. Some operators as they, advance in their career, they get into different projects, you'll see higher minimum rate, 100,000 bucks, but yeah, 50 is a pretty standard number in the industry.
Okay, so now you mentioned something, the private money fund. Tell us about that and what you're doing with that as well.
Yeah, so I started this fund actually got me into the business, and I found this was to whom I consider a mentor, and I was talking to this guy. He's very risk adverse, and that matches me. And I said, "Where are you putting your money? What do you do?" And so he talked to me about this fund, and basically it's private lending. There's a pool of about 450 homes on any given day, and they're writing about 40 to 50 loans per month. It's these are for fix and flippers that are borrowing, and we hold first lien position. There's no bank leverage, so no other parties involved, and they're lending at like 65% of the value. So for me, I was thinking, okay, this is very safe. $100,000 home, they're lent 65 grand. If they foreclose, then we have this asset now for 65,000. But what really sold that one was the team. It was a team of ex flippers. So they got out of the day to day. They're now on the money side of it. So it doesn't matter if that flipper profits, you know, the borrower profits 30 grand or 100 grand, as long as we're getting our points on that note, then all is well. So that one's cool. It's to me, I consider a low risk, product. It's 8, 9, or 10%. So, and I tell people there are better deals out there. When I say better deals, like higher returns for sure.
Well,
Uh,
but with that aspect of things, you're getting 8 to 9%. The money's continue to do that.
yeah,
They're probably making a little bit on the arbitrage between the 8 and 9 and what they're charging fix and flippers,
that's right. What
right?
they're charging the borrower. Yeah. And that
Yeah,
goes to
and
pay
then
the team.
yeah,
Investor gets paid first. So if they're making 8%, their 8% gets set aside. The delta goes towards the team, the arbitrage. Um, and so, yeah, it's a good gig. And it's, that one I get really excited about, but it's interesting. So there's as I talk to investors and people that come in on board with us, there's a different demographic that likes each of them. So I always have the private lending fund. It's always open. It's liquid. You can pull in and out. So that's attractive versus like a 1 year lockup on something. But most of the people that like that one are generally 50 and up, 55 and up, because 8, 9, and 10% is amazing. They don't want to mess with volatility in the market. They don't want swings. They don't have the longevity to say, let's look at equity and appreciation. So that one's really good for that versus the people that seem to be more excited about getting into the property side with the mobile home parks. They're looking for equity, long-term appreciation, monthly cash flow, but there's a unique separation between who likes what. And my job is just to tell people, hey, what's your risk tolerance? What do you like? What fits your situation? Like I talk to business owners that have 300K in their bank accounts, and I'll ask them, number one, good job, but why do you have 300? Why does it sit there? How much do you really need when payroll and rent and expenses come around? And that answer might be 50K. All right, well, you're having 300K sit in the bank. You're earning zero on it. Meanwhile, the bank, the big banks, right, or small ones, they're taking your money and they're lending your money out and they're making money on your money. So why aren't you doing it? Why would you let the bank do it and not? That's your money. So I like having these conversations just to get people thinking about, hey, put your money to work, give every dollar a job, and it pays off. You're not going to see it a lot in the beginning, but if you have that mindset and keep doing it, you cannot unsee it once you see the value in it.
hmm. Well, I love what you're saying there because I'm a big believer that every real estate investor that gets into real estate eventually wants to become the bank or become the lender. And I
Yeah.
have to give you another shout out. You're in the note business because you're creating notes on the fix and flip side. You're just doing the money origination side. So you really are a note investor of some sort there, Ian.
Yeah. Seller finance a little bit on the business too. So we
Yeah.
got there's notes all over the place. We talked about this earlier. Lots of ways to make it in this
Yeah.
space.
Now, what's the best way for our folks out there listening and watching us to connect with you to find out the different opportunities that are available, or to have a schedule a call, see which way they would see which road they would fit in best?
Yeah, for the listeners of this show, I created a cheat sheet for passive investing. It's a little chart that's going to show you what questions to ask if you're curious about how it works, from behind the scenes stuff, getting into your first investment. So really good toolkit that you can use for anybody. We'll leave that link in the show notes, and my website's runsteadyinvestments.com. But yeah, and if you're an Austinite, I love meeting in person. I'm a millennial by definition, but I don't fit into the norm. So please, I, it's funny. I already say that, I'm like, oh, that generation beneath me, that those guys, so now you see how your parents look at this stuff of
Yeah.
what the generation beneath us does. But yeah, love face to face, meeting people, getting out and knowing, others, business owners in the community.
That sounds good. Definitely we'll have to meet up for coffee or a
Yeah.
cocktail at some point for sure there. All right, guys, that's going to wrap it up for this episode of the show. Make sure you subscribe and share it with somebody else, but take advantage of what Ian mentioned there. Reach out to runsteadyinvestments.com. Like I said, we'll have that cheat sheet linked in the show notes in the description there for you, so to take advantage of that. But go out there, take some action. If you're sitting on the sideline looking to get started, as he said, I say, you're going to learn more from doing your first deal. If you need some ways to do it passively, got some opportunities here for you to do. So go out, take some action.